Okay, here we are in plan video number 2. So continuing off of where we were before, I've got a spreadsheet here that I'll kind of walk you through. Okay, so first off, and just for the sake of getting all of the pieces of the puzzle out and on the table for us to take a look at, I'm going to go through, this will be a more of a higher level discussion of the various puzzle pieces and their purpose and what ultimately we're trying to accomplish. And then following, or I think maybe with our next conversation and maybe a follow-up video, we can get much more in depth into the specifics of each puzzle piece. Okay, so we're going to look at the puzzle and how it's comprised of these pieces. Then we can dig more specifically into those individual pieces and kind of have a better understanding of how they work. For now, the company that I ran this policy with is called One America. Okay, so this kind of taking into account what I just mentioned before, a $30,000 total capacity. That $30,000 total capacity is just the ordinary premium, base premium plus paid-up additions, which we'll talk about. But what I've also brought in, you'll notice in this first year, it shows $92,000 going in. Well, that's the 40 some odd thousand of existing cash value that you have in your current UL policy. That would come over via 1035 exchange, plus the 30 that we would work into the policy just as ordinary premium, plus another 20,000 of just cash. That's what gets us to that 92 number. Okay, if we're at that 92 number, we immediately have access to a little over 81, okay, and a death benefit of $677,050. Okay, so your death benefit goes up a little bit versus your UL policy, but so does the premium and so does the cash value. Okay, now in year 2 and beyond, so through our 8-year window of time, we're funding our policy just at the normal 30, right? Again, I'm just trying to build that into what we have access to. If you feel good or comfortable about that 29 to 30, again, that's not 29 to 30 plus 15, that's just that 30 that you felt like you had disposable. Let's work that in over this 8-year window. You can see our cash value numbers continuing to build. And then after that 8th year, there's no new premium going into the policy. We offset, or more technically accurate is we reduce pay up this policy. So that cash surrender value goes up. There's an initial decrease in the death benefit, which I'll talk about as we get into more detail. But the death benefit adjusts to reflect the fact that no new premium is going in. But you'll notice that the death benefit, even after the adjustment, the death benefit begins to recover immediately. So you've got cash surrender value that increases over time. And there is no increasing cost of insurance component in a whole life policy like there is in a UL. That's why we like the whole life much, much better than the universal life. It's not that we can't build a universal life. We absolutely can, but we choose not to because that increasing cost of insurance variable, that's problematic if we're going to use this policy for other purposes. Okay, so that's the policy piece. Now, what are we going to use this cash surrender value for? We talked a little bit before about this notion of, and you mentioned it in your financial summary, this idea of using the policy, leveraging that cash value, getting out and working for you, and acquiring cash flowing assets. Well, Exhibit A, or the epitome, I guess, if you will, of a cash flowing asset is a piece of real estate. Okay, so now I'm going to jump into a different section of this spreadsheet. Okay, we're going to jump over here where you'll see, keeping your eyes on this left-hand part of the spreadsheet, you'll see the same numbers reflected. I just copied and pasted your policy values into this portion of our spreadsheet. What you'll notice on this portion over here, though, this monthly value, policy values, is this is going to show us using our policy. Okay, so we're using our policy in the following ways. Okay, and I'm actually going to toggle over to this main tab right here. Okay, the assumption is this. Okay, each of these is a rental property that you acquire, and I kept it simple for numbers purposes. And this again is something that we can dive into far greater detail with. But I said, well, let's assume that you're buying a $100,000 rental property. Okay, you're going to put $20,000 down. Well, 20,000 or 20% down is $20,000. Okay, that means you're financing 80. You put 20 down. The assumption that we're going to make is this 80 is financed at a rate of 5%. So that our spreadsheet incorporates what your mortgage payment will be on that 80. And it also considers, or it also factors in, the policy loan rate on the 20. So the $20,000 down payment, we're going to use our cash value. We're going to take a policy loan, and that policy loan is going to give us our down payment. Okay. Then you can see over here, and not getting into the weeds too much, I'm going to assume some rents. We're going to assume operating expenses. We're going to assume net operating income, and then we're going to assume cash flow. And all of these variables can be adjusted and tweaked, but really what I used them to do was to give us a very basic, very doable 10% cash on cash return. From my own perspective, I can't remember if I talked about this when we met last week, but I don't look at a rental property unless it gives me a 10% cash on cash return. That's a doable number. I have 18 rental properties between myself and my two business partners, and 10% cash on cash return is what we insist on every single time. So you can do better, and depending upon timing and time frame and what's happening in the real estate market, you can do significantly better. So this 10% number is just a very middle of the road number. I didn't want to assume something overly rosy or just unrealistically positive, just a doable 10%. Okay. Now, if we come back over here, every time I show you, every time you see one of these 20s, this is you acquiring a new property. Okay, so right out of the gate, you have $81,000 of cash value. Well, if we're acquiring these types of bread and butter, single family home, $100,000, 3-bed, 2-bath, you can immediately, right out of the gate, aggressively buy into that type of asset class. So I show a property month 1, a property month 2, a property month 3. Okay, and so you'll see that as we're taking these policy loans, our policy loan balance is increasing. Our end of year policy loan value, this is showing the net cash value that we have, what we have available to deploy for other investment if we choose to. This is our net cash value column right here. Okay, so in other words, where our policy loan values are going up because we're using those funds to acquire properties. You'll see that our loan interest expense is factored in as well. Everything is accounted for in our calculator. But what you'll see though is as we acquire a property, we've got cash flow. As we acquire another property, we've got more cash flow. As we acquire a third property, we have even more cash flow. Okay, you'll see these numbers increasing as well because I built in an inflation number. Obviously, over time, you're going to be able to increase rents. That's going to be reflected in this column. But just to make it simple, I have it reflected just by a small amount each month, even though you're not going to increase your rents each month. You may do it each year when a lease is renewed, but just for simplicity's sake, it's built in on a monthly basis. Okay. Now, so we aggressively, we get in and we get that cash value moving. Then what you'll see is about a year later, we're again in the position to be able to acquire another property. About a year after that, we're in position to acquire another property. And again, all the while, we're taking our cash flow, and that cash flow is flowing back into our policy to be applied towards our policy loan balance, which frees up our cash value again so that we can again deploy it. And again, as our policy is being funded and our cash values increase because of the funding, the additional capital that we're paying in, all of that is combining to give us the ability to continue to get that cash value out and working for us. Okay, so again, at that mark, we buy another property. Then things start to pick up. The pace starts to pick up. Where about every 6 months now, we can acquire a property, and then another one, and then another one, and then one final property. So I show you being as aggressive as you can over the next 4 years. Okay, so by my calculation, you should be able to acquire 1, 2, 3, 4, 5, 6, 7, 8, 9 properties over that 4-year window of time. So that's where these properties are reflected. Those 9 properties are reflected. Okay, now we're not done, of course, because we're operating as much as we can within that 8-year window. So your cash flow, right, is steadily increasing as we add new properties to the mix. But what we want to do first, before you start to reroute this cash flow and take it and use it as income, we want to direct as much of it as we can towards our policy loan balance, so that over time we can completely deleverage and have a net, just a net cash value number, right? That's unencumbered. Okay, so what we'll do is so it's at the 11-year mark. Okay, and before you get concerned about, well, what happened to the 8 years? We'll talk about that. But at the 11-year mark, so we aggressively acquire properties over the first 4 years, then we aggressively use our cash flow to pay down that policy loan balance, so that at the 11-year mark, so this would be month 132, we've paid back our policy loan balance. We have a net, just straight $387,000 of cash value, and we're cash flowing at about $2,600 a month. So over that window of time, we've created $2,600 a month of cash flow per month, and we have $387,000 of cash value that is completely available for us from that point on. That's what we're using the policy to do. It's this cash flow, and then it's getting ourselves in a position to have that big pool of cash value that we can use for other purposes. And I'll get to that here in just a second. So hopefully this is making sense, that we're getting our cash value out and working for us. We're acquiring cash flowing assets like real estate. We're taking the cash flow and we're pumping it back into the policy towards the policy loan. And ultimately, we're going to put ourselves in a position to where we have the cash flow that we can use for retirement income, and we have the cash value position in our policy that we can also use to create additional retirement income. Okay, so hopefully that is making sense there. So maybe flipping back to here. So kind of part 3 is we want to buy real estate, and that will allow us to create passive income. And then in addition to that, we want our cash value to create additional passive income. Okay, and looking at the clock, I think I'll kind of wrap this second part of the video up and then shift to part 3. But this is where we are with the policy. We want to fund it aggressively. We want to acquire real estate. We want that passive income. We want the cash value. Okay, all right, I'll stop part 2 and go ahead and head over to part 3.